Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
Okay, we'll make a start. We'll start off by talking about your mid-semester exam next week. So you have 15 minutes reading time. You have 90 minutes of writing time. You'll get some scribble paper if you need it. The exam is closed book, which means you just bring a calculator and a pencil. And that calculator has to be non-programmable, so graphics calculator and financial calculators are not allowed in the exam. There are 3 questions. Each question has unequal value, and in fact, all contain multiple parts as well. There's a mixture of calculation and theory type questions. Most of the questions are calculation type. The exam's worth 25% of your assessment, so it's also worth 25 marks. And the first 4 lectures are examinable. Okay, so today's lecture will not be in your exam, but the first 4 weeks are examinable. And as I mentioned last week, you will not need to know how to draw the option trading strategies, but you may need to know what those strategies are, how you'd create them, what you'd use them for, etc. Okay, so that is your exam. Difficulty, I don't think it's a difficult exam. There'll be no surprises, right? So nothing you haven't seen before. In the exam, you may not like that I've asked a question, okay, but it won't be a surprise. It's something definitely you have covered in the material on the course, whether it be tutorial examples, lecture examples, material covered in tutorials, and lectures itself. Okay, so there shouldn't be anything that's of a surprise. You have 90 minutes. It shouldn't take you the full 90 minutes to do the exam. So when I did the solutions over the weekend, it took me about 40 minutes, okay, to write up those solutions. So you should be done, hopefully, in a little over an hour, so then you've got use that time to check your work. Okay, check what you've done in your calculator. Have you made any mistakes on your calculator? Have you not read the question properly? Right, something like that. Okay, so please use the extra time you have to check your work and make sure you've made no mistakes. Okay, are there any questions anyone has about the exam next week that you'd like to ask me now? As I said last week, the only time I'll answer questions about what is in the exam is in this lecture. That way everyone in here gets to hear it and it's taped so everyone else gets to hear it. If you come to my office or send me an email, my standard response is that may be in the exam. Okay, is there anything you'd like to ask me? Now is your opportunity. No questions at all. Okay, so the question is, are things like currency swaps examinable in the mid-semester exam? Potentially, right? So last week I did an example of a currency swap as well. So I think that would be fine to do a currency swap. What I will say is that you will not be expected to value a currency swap. Okay, so if you had to value a swap, you would be valuing an interest rate swap. Okay, if that were in there. No, that's not me saying it's necessarily in there. I'm just saying if you were, it would be on that, not on valuing a currency swap. Other questions? See, that was good. You got something out of that. Something you don't have to study. Anything else? Any other questions? Last opportunity. Normally I get like 20 questions. This is interesting. Don't be shy. I'm in a good mood. Ask me questions. Last chance. Okay, so your exam obviously is next Tuesday. If you haven't looked up the details, whether it's been emailed to you or not, if you go to examinations at ANU, you'll be able to see the time and location. Remember, you have to go to the various location based on your last name. If you don't go to that location, they will not have a desk there for you because you have assigned seating. So please make sure you go to the correct location for your exam. Otherwise, you'll be running across campus, or not across campus, but to a different venue and that would not be good. Okay, please bring a non-programmable calculator. Please, please, please. Okay, but hopefully you shouldn't find anything in there unsurprising. Okay, if you can do the tutorial questions, you can do the examples we've done in the lectures, you should be fine to pass this mid-semester exam, no problems. Okay, so that mid-semester exam will be marked during the break, and then you'll get to view it in your first week back after the break. Okay, so you'll view it in your tutorial group. Solutions will go up over the break as well, and I'll put up the results just before you come back as well through Gradebook on Wattle. Any questions? Okay, fantastic. Okay, so let's look at today's lecture. So today's lecture is when we start valuing options. So today we're trying to find out what is the call option premium and what is the put option premium. And the model we use today is called the binomial option pricing model. Okay, so it's a simplified model where we make some assumptions. And those assumptions are essentially one of two things can happen. Prices can go up or prices can go down. Okay, so we're in a two-state world. Prices either go up or they go down. And they can go up or down in different ways. Thank you. Up the back, thank you. We're just waiting on you guys. When you're ready, thank you. Okay, so they can either go up or down to a certain price. They can go up or down by percentages, or they can go up or down based on volatility. Okay, so there are three different ways we can look at price movements, and we'll cover all of those today in the lecture. Okay, so what's a little bit unrealistic, and we'll see the model in a minute, is that we're making this assumption that it is only a two-state world. Okay, obviously that's not perfect, right? Because prices aren't just going to go to two different places. They could go to an infinite number of places. Okay, but what we use is we use all the available information in the marketplace to make an assumption about where prices will end up. And hopefully taking into account the probabilities of prices going to certain areas encompasses those middle areas as well. Okay, but before we start today, the one thing we're going to look at is what happens with strike prices. So we need to make sure that we're happy that when we look at strike prices, we know what will happen to our option prices. Okay, so let's look at what happens when we change X. Okay, so my strike price of my option. So with a call, remember my payoff. What's my payoff with a call option? Out loud, ST minus X. Okay, so what happens when the strike price goes up with a call option? What happens to the option payoff? Does it go down or up? It goes down, right? Because your payoff is ST minus X. So if ST stays fixed, but X increases, you get a lower payoff. So in that case, your option payoff goes down. Now, if the exercise price is lower, what will your option payoff be? Higher or lower? Higher, right? You make a bigger payoff. The reason this is important is when we value options, we will have maybe two identical options. So we've got two options on Qantas Airways. ST will be the same with both of those options, because in 6 months' time, the stock price of Qantas will be whatever it is in 6 months' time. Right? That's got nothing to do with the exercise price of the option. But you've got a choice between buying two options, two call options, and they might have different strike prices. So one might have a strike price of $5 and one might have a strike price of $7. And the point there is to figure out which one should be more expensive. And as we've just shown, obviously the one with the lower strike price should be more expensive, and that should make sense from foundations of finance. Right? The price, remember from foundations of finance, the price of any financial asset, so whether you valued shares, whether you valued bonds, what did you do in that course? What did you have to identify? Future cash flows. So you had to identify future cash flows, whether it was dividends, whether it was coupon payments. Here, what's your future cash flow? The exercise of the option. So ST minus X. So that's your future cash flow. exercising the option. ST remains constant. The only thing that changes is the exercise price of the option you want to buy. So when we value options, we look at the payoff from the option, which is ST minus X. That's number one. Number two, we look at the probability of getting that payoff. Okay, so a bit like when you looked at expected returns in Foundations of Finance, you multiplied the outcome by the probability of getting that outcome. We do the same thing today. We've got our payoff, and we multiply that by the probability of getting the payoff. So this potential payoff, am I 30% likely to get it, 80% likely to get it? And then this payoff, remember, is not today, it's in 6 months' time. So I have to find the present value of that payoff. So the three things you do today are identify the payoffs, take into account the probability of getting those payoffs, and then find their present value. And that is the value of the option. That should be the call option premium or the put option premium. That's all you do today, and we do it using a tree diagram. Okay, two potential states of the world. Next week, we look at the Black-Scholes model, which takes into account other factors. But today, we use the binomial option pricing model. Okay, so that's what the scenario is for call options. What about for put options? Well, it's the reverse. The payoff for a put option is X minus ST. So in this case, ST again remains constant. What we change is, what's the exercise price? Do I lock in to sell a Qantas share for $7, or do I lock in to, or have the right, I should say, to sell a Qantas share for $5? Well, obviously, if X goes up, does my payoff increase or decrease? Fantastic. Option payoff increases. And if X goes down, then my option payoff decreases. So if my option payoff increases, the option should be more expensive. Remember those three factors: payoff, probability, time value. So if I increase the payoff, it should be more expensive, the option. If I decrease the payoff, it should be cheaper. Okay, less expensive. Everyone okay with that? Okay, good. So this is really important. This is like the groundwork for what we're going to do a little bit today. I got a couple of, a couple of emails throughout the week regarding last week's lecture, and that was that I mentioned to you these reverse spreads, right? So I mentioned a reverse butterfly spread, and people said, I spoke about how you created it, but didn't sort of write it down, so I'll write it down for you now. So a reverse butterfly spread, remember, looks a little bit like this. It's just that butterfly spread turned upside down. This is option with an exercise price of X1, X2, and X3, where X2 is in the middle of X1 and X3. So to create this option, you sell a call or a put, either one, with a strike price of X1. You sell a call or put at a strike price of X3, and you buy two calls or puts at a strike price of X2. Okay, that's how you create a reverse butterfly spread. For the reverse calendar spread, looks a little bit like, kind of like that. Okay, you buy a short, a short maturity call or put option, and you sell a longer term maturity call or put option, and they both have the same exercise price. Okay, they both have the same exercise price. All that differs is the timing, okay, so the life of the option. Any questions? Okay, so what we're going to do is we're going to introduce the binomial option pricing model, and we're going to do it twice, okay, just to make sure everyone's happy with what we're doing. The first time I'm going to go through the slides, and the second time I'm going to do the same thing but going through overheads, just to slow it down a little bit. Okay, so in the past, people kind of look at this example and they think, oh, okay, I have to do this every time. Rest assured you don't. Okay, this is just going to show you how we get to the formula, which you'll use from now on. Okay, so I'm never going to ask you to replicate this in an exam. Okay, this just shows us how we get to this formula and how it works and what the rationale behind it is. Okay, so here's a very simple, what we call one-step binomial tree. And the stock price today is $20. And in our world, over the next, 3 months, it can either go up to $22 or go down to $18. Okay, those are the two scenarios that are likely to happen. Stock price goes up to 22, or the stock price goes down to 18. So obviously what we're going to do down here is, at this point, we're going to look at what would the payoff be if I had an option on this stock. Okay, so I'm going to compare the spot price to the exercise price of an option. But we just start today at $20. Prices can either go up to 22 or down to $18. So let's imagine there's a call option on this stock with a strike price of $21. Okay, so the call option has a strike price of 21. We look at our tree and we say down here, right, what are my payoffs? So when the stock price is 22, remember the payoff from a call option is ST minus X. So 22 minus 21 will give me a payoff of $1. Everyone okay with that? So it's just 22 minus 21 is my $1 payoff. Down the bottom, well, my stock price is 18. 18 minus 21 gives me -3. Do I exercise the option? No. So I don't exercise the option, so the payoff is 0. So remember, in this scenario, the option doesn't get exercised because call options only get exercised when the spot price is higher or greater than the exercise price. So it will not be exercised down here. Everyone okay so far? Just looking at simple payoffs. So then we talk about how would we create a riskless portfolio. So by creating a riskless portfolio, what I mean is, at the very beginning, I'm going to own a certain amount of shares, and I'm also going to have a position in a call option. And for this portfolio to be riskless, that would mean that whether prices go up or prices go down, my portfolio will be worth the same at the end. So there's no risk. So I want to create a portfolio that if prices go up or down, that portfolio's price does not change. Okay, so the price of the portfolio doesn't change. So how do I do that? Well, if prices go up, right, so I own the stock and it's worth $20, so shouldn't say that. The stock at the beginning is worth $20 and it then goes up to 22, that's kind of like a $2 gain. If at the beginning the price goes from 20 and then goes down to $18, that's a $2 loss. So what I'm going to try and do is negate or get rid of any potential gains or losses by having a position in an option. So the question is, what position must I have in an option? Well, if I own the stock and the price goes up, yes, thank you. Haven't got there yet. So if prices go up, I'd make a gain. How do I negate or how do I get rid of that with a loss? I have to have a short position in a call option. Because when that call option gets exercised, the holder makes a gain and I make a loss. So it kind of offsets what happens in the stock. Likewise, if prices go down, well, I kind of keep that option premium that I would have got paid at the beginning. So to set up what we're going to call a risk-free payoff here, or a risk-free portfolio, I'm going to be long, I'm going to buy a certain number of shares, and I'm going to be short one call option. So that delta, that triangle, that's what I have to solve for first of all. How many shares do I have to buy such that with my short one call option, I have a risk-neutral portfolio, right? I don't lose or gain any money. So at the end, right? So at the end, my payoff or my value of my portfolio at the top to be riskless has to be equal to the value of the portfolio if prices go down. Now, what's the value of my portfolio at the top? Well, it's the spot price of $22 multiplied by the number of shares I own, which is my triangle, my delta, minus a $1 payoff from the option, right? The person in the long position gets a $1 payoff. Because I'm short in one call option, I'll make a $1 loss. If prices go down, then I get $18 multiplied by the number of shares I own. So now I need to solve for, well, how many shares must I buy at the beginning? For this to be riskless, the top, 22 delta minus 1, must be equal to the value if prices go down, 18 delta. So I say 22 delta minus 1 equals 18 delta. And that means I have to, imagine you could, that means I have to buy a quarter of a share. So at the very beginning at time 0, when spot prices are $20, I buy a quarter of a share, and I short one call option. Now, no matter what happens, at the end, the value of my portfolio will always be worth the same amount, whether prices go up or prices go down. So, what is the value of my portfolio in 3 months' time? Well, I can do it two ways. I can say 18 times a quarter, or I can say 22 times a quarter minus 1. Either way, I end up with $4.50. Okay, so whether prices go up or down, my portfolio in 3 months' time is worth $4.50. So if it's worth $4.50 in 3 months' time, what's its value today? Well, I just discount back that $4.50 3 months to time 0. So I say $4.50 times e to the negative risk-free rate, which in this case is 20%, multiplied by 3 on 12, a quarter of a year to give me 4.367. So at the very beginning, my portfolio is worth $4.367. How many shares did you own at the beginning? How many shares do you own at time 0? A quarter, 0.25, a quarter of a share. What's the value of that quarter of a share? What's the beginning stock price? $20. What's 20 times a quarter? $5. So your shares are worth $5, and your portfolio is worth 4.367. So the question is, what is the option worth? Well, the option's obviously worth the difference between $5 and 4.367. So your option's worth 0.633. Because you're the writer of the option, it actually has a negative value to it, okay, which is why we say the $5 shares minus the 0.633. Why has it got a negative value? You're short, so you've been paid the option premium at the beginning. How do you get rid of the option? It's got a negative value because to get rid of the option, you have to give it to someone else and then pay them the option premium. So you'd have to pay them 63.3 cents. Okay, remember you've already received that 63.3 cents at the beginning. So your portfolio is the $5 shares plus, so a quarter of a share, which is worth $5, and then you've got this call option that you're short in, but it's got a negative value, right? You've already been paid the option premium, so you ignore that. Now think about if I had to get rid of it, I'd have to pay someone the 63.3 cents. Okay, and that's how you work out the value of the option. You're never going to have to do that, though. Okay, you have a nice formula that you're going to use. Okay, but this is where the formula comes from. So this might seem like overkill, but we're just going to go through this again slowly on an overhead, and then we will look at how we kind of get to our formula. So we have our call option. That's what we're trying to value in this question. And remember, the payoff from a call option is the maximum of st minus x and 0. And the rule for using the binomial option pricing model, which we mentioned at the beginning of the lecture, is I calculate my payoffs. I find the present value of these payoffs, taking into account the probability of getting those payoffs. Okay, probability of getting those payoffs. So kind of, I'll just do a two-step tree. These are all the payoffs, right, that we could potentially get. So we're looking at the payoffs at these places, the probability of getting them, and then their present value. And you actually kind of did that in the example below, before, right? But we're going to get a formula to look at it in a minute. So in the question we have today, we have spot price today is $20. It can go up to 22, or it can go down to 18. And my payoff is equal to st minus x, so 22 minus 21 to give me a $1 payoff. And here, 18 minus 21 to give me negative 3. So my payoff is 0 because I don't exercise. And then we can start thinking about the probabilities. And so we use P. P is my probability of moving up the tree. Because probabilities have to add up to equal 1, 1 minus P is going to be my probability of moving down the tree. Okay, so I've got to solve for these probabilities, which we'll do a little bit later. But P is my probability of moving up, 1 minus P, the probability of moving down the tree. Okay, so my portfolio, to prove the binomial option pricing model, is I have to own delta shares and I have to short one call option. So the first thing we need to solve for is delta. How many shares do I have to own? Do I have to buy? So at the beginning, you own delta shares. So at the end, if the price goes up to 22, the shares are going to be worth 22 times delta. That's just the number of shares you own, minus the $1 payoff because you're short in the call option. Okay, the payoff is $1, but you're short, so you make a loss of $1. And down here, if prices go down, well, your portfolio will be worth $18 multiplied by delta, the number of shares you own. This has to be equal to that if it's risk neutral. Risk neutral means there's no risk. Whether prices go up or down, my portfolio will be worth exactly the same amount of money. So that means 22 delta minus 1 is equal to 18 delta. So that gives me 4 delta equals 1. So delta equals 0.25 or a quarter of a share. So I buy a quarter of a share and I short one call option at the very beginning. And then we have to work out, well, what is this all worth at the end? There are two ways you can do it. You can say 22 delta minus 1, so 22 times a quarter minus 1 equals $4.50, or you can say $18 times delta, so 18 times a quarter, which also equals $4.50. So no matter what happens, your portfolio at the end is worth $4.50. So the value of the portfolio today should be the present value of $4.50, which is going to be equal to So imagine R is 12% per annum, compounded continuously. So $4.50 times e to the power of negative 12% times a quarter gives me 4.367. And at time 0, a quarter of a share is worth a quarter times the spot price at time 0, which is $20, which gives me $5. And you're short one call option. So $5 plus the call option premium is equal to 4.367. So the call option is worth negative 0.633. Okay, it's worth negative 63.3 cents to the person in the short position, and in the person in the long position it's worth positive 63.3 cents. Okay, either way you've worked out the value of the call option, okay, by using excuse me, this particular method. Okay, hopefully there has to be an easier way. It'd be very difficult to do that in a two-step tree. So what we do now is we substitute all that we've done here with numbers with letters. And we derive a formula. You don't need to know how to derive this, but now that we've done the groundwork, hopefully when we go through the letters you can see what's happening. I'm not swearing at you when I say some of these things. This is just the terminology we use. Okay, so at the beginning, S, that's just the spot price at the very beginning. And then the lowercase f there, that is the value of the call option. That is the call option premium that you're trying to solve for. So our 63.3 cents. Then if you go up the tree, you have SU. Okay, so SU is the spot price if prices go up. So that was our $22 beforehand. And FU is the option payoff if you go up the tree. So the $1 we had before. SD is the spot price if prices fall. So our $18 from before. And FD is the option payoff if prices go down. In this case, it would have been $0 from the previous example. Then what did we do? Well, same as before, we're going to be short one call option and we're going to own delta shares. We have to solve for that. So like it was before, remember it was 22 times delta. Now we just say SU, the spot price if I go up, multiply by delta, the number of shares I own, minus FU, okay, the payoff if I go up the tree, which was $1 before. So exactly the same as before, we've just replaced it with letters. If I go down the tree, spot price if I go down, which was $18, multiply by delta, the number of shares I own, that's what we're trying to solve for, minus FD, my option payoff if I go down, which is 0. The portfolio is riskless when the top is equal to the bottom. And then if I rearrange to solve for delta, delta is going to be equal to FU minus FD divided by SU minus SD. That's just what we did before. But it was easier because we had numbers. Now we have to express it in terms of letters. Okay, so in other words, we get the FU and FD on the same side, and then we have to divide by, get rid of the delta, so we divide by SU minus SD. The value of the portfolio at time t, so if we take the top one, is just going to be SU delta minus FU, and the value of the portfolio today is SU delta minus FU times e to the power of negative RT. So what is that? That's just what we did before. $22 multiplied by delta, the number of shares you have to own, minus the $1 payoff. And then you find its present value by multiplying it by e to the power of negative RT. Another way to express that is, if you like at the beginning down here, it's just going to be S times delta. Okay, spot price at the beginning multiplied by the number of shares you own minus the value of the call option. Okay, what we're trying to solve for. So again, like we did before when we said 4.5 times e to the power of blah equals 4.367. We say S delta minus F is equal to SU delta minus FU times e to the negative RT, and we just swap it around so you've now got solving for F. Okay, F equals S delta minus SU delta minus FU times e to the power of negative RT. And then we have to substitute for delta, and remember delta is equal to FU minus FD divided by SU minus SD. So if we substitute that into our equation at the bottom here, we end up with this nice formula. Okay, we don't need to know the maths or algebra behind it, but this is the formula you need to learn in this course. So this is to find the value of either a call option or a put option. Same formula. The value F of a call or put option is going to be equal to the present value. Now remember what we said at the beginning of the lecture. The value of any financial asset, and therefore the value of an option, should be the payoff from that option, taking into account the probability of getting that payoff, and taking into account the time value of money. So we look at that formula. F is equal to e to the power of negative RT. That is the time value of money. You've taken into account the time value of money. Is equal to P. P is my probability, remember I had it up before, of moving up the tree. So that's my probability taken into account. So my probability of moving up the tree multiplied by the payoff if I move up the tree. Plus 1 minus P, that's my probability of moving down the tree, multiplied by the payoff if I move down the tree. Where P, okay, my probability, and this is probably the most important thing, is equal to ERT minus D. So D, we're going to talk about how we calculate. There's three ways. Divided by U minus D. So kind of D and U, obviously U's going up and D is going down. Okay, so the above two equations enable an option to be priced using a one-step binomial tree. And in fact, you use the same formula for a two-step or a three-step binomial tree as well. So let's talk about yep, we've covered that. So let's talk about calculating P. So we just said that P is equal to ERT minus D divided by U minus D. So remember, P is my probability of moving up the tree. There are three ways you'll need to calculate this. Number one, I tell you that prices go up or down to a dollar value. So in this example, I told you they went up to 22 or they went down to 18. If that's the case, to calculate U, it's just the price if I go up divided by the beginning price, which gives me 1.1. And for D, it's the end price if I go down divided by my beginning price, which gives me 0.9. Number two, I tell you that stock prices go up or down by a certain percentage. So let's imagine I tell you they go up by 25% and they go down by 15%. Okay, that's the state of the world I live in. Prices can either go up 25 or down 15%. In that case, U is going to be equal to 1 plus 0.25, so 1.25, and D is going to be equal to 1 minus the percentage decrease of 15 to give me 0.85. And the third way is see slide 28, which we'll do at the end. We have to introduce something before we do that. But essentially, I tell you prices go up or down to a dollar value, excuse me, or go up or down by a certain percentage. Any questions so far? So now let's have a look at what we did at the beginning of this lecture, but instead of doing the way we did at the beginning of the lecture, we use the formula we've just created. Okay, so I have the same setup. Dollar payoff if I go up, zero payoff if I go down. The first thing I need to calculate is my P's. What's my probability of moving up the tree? And because I'm given a dollar value, I use, for U, 1, I use the 22 on 20 to give me 1.1, and for the D, I have 18 on 20, which gives me 0.9. So P is equal to ERT, so e to the power of 12% times a quarter. Now that T is the length of one step of the tree. Okay, this is the most important thing. T, in this case, we're looking at the probability of moving up or down one time step. When you do a two-step tree, don't put in 6 months. This is your probability of dealing with one time step of the tree. So e to the power of 12% times a quarter of a year, 3 months, minus 0.9, that's my D, divided by U minus D, 1.1 minus 0.9, to give me 0.6523. So there's a 65.23% chance I'll move up the tree, and there's a 1 minus 65.23% chance I'll move down the tree, which is 0.3477. So the value of my option, remember, is just e to the power of negative RT, so e to the power of negative 12% times 3 months, multiplied by P, probability of moving up the tree, 6523 times the payoff of $1, plus the probability of moving down the tree, 0.3477, times the payoff, which in this case just happens to be 0. I plug that in and it gives me the same 63.3 cents. Okay, but this is hopefully much easier than using my risk-neutral valuation we did at the beginning. Just going straight ahead and using the formula. Any questions? Okay, so let's introduce another step. Okay, introduce another step. So now this is a 6-month option. Okay, it's got a life of 6 months, and each step is worth 3 months. Okay, so the length of each step is worth 3 months. And again, prices can go up. To get these values, essentially all you've done is multiplied the 22 by 1.1 to go up the tree. And then to go down the tree, you multiply the numbers by 0.9. So it gives you the 24.2, the 19.8, and the 16.2. The call option still has an exercise price of, excuse me, of $21. Okay, so let's do this on an overhead. So we start off at 20, we can go up to 22, down to 18, up to 24.2, 19.8, and 16.2. How many ways are there of getting to 24.2? 1. How many ways are there to get to 16.2? How many ways are there to get to 19.8? 2 ways. So any payoff you find here, you have to multiply that by 2, right? Because there's 2 chances of getting that potential payoff, going up then down, or down then up the tree. So if you do have a payoff here, you have to multiply the payoff by 2. Turns out in this case there is no payoff, right? Because the option has an exercise price of $21. So let's work out my payoffs. What's my payoff here? ST minus X, what's the payoff? 24.2 minus 21. My payoff is $3.2. Here my payoff is $0. Don't exercise the option. That's a 0. And here the payoff is also $0. I don't exercise the option. Now we solve for P. This is my formula. And remember what I said before, this T here is the length of one time step. Okay, so don't put in 6 months. That's the length of the option, or the time span of the option. We've got a P here and another P here, right? You go up the tree once, go up the tree twice. So P is your probability of just moving up once. And it'll be the same here and here. So that's equal to e to the power of 12% times a quarter minus 0.9 divided by 1.1 minus 9. So it gives me the same 0.6523. This is a European option. Because it's a European option, you can only ever exercise it at the end, which means we don't care what happens here or what happens down here. Because it's European, you can't exercise it early. So to find the value, it's e to the power of my risk-free rate, negative 12%. The length of each time step is a quarter, and there are 2 time periods. Right, so we've got to bring this $3.20 back 6 months, not a quarter. What's the probability of getting that $3.20? If this is P, and this is P, what's my probability of getting the $3.20? Someone said it, P squared, right? P times P. Right, it's 0.6523 is the chance of getting to here. Then I've got to multiply it by another 0.6523, right? Because I've got another 65% chance of moving up the tree. So I multiply it by 0.6523 squared. Or you can just write 0.6523 times 0.6523. And that gives me 1.2823. So the value of the option is $1.2823. All that's changed in this question is the length of the option. Risk-free rate stays the same, exercise price stays the same, but we've increased the value of the option. And that makes sense. As you increase the time to expiry, you should increase the value of the option as well. Any questions? Yes? Why is... No, sorry, that's a bracket. That's a bracket. So 0.6523 squared. Other questions? Okay, so this is a European. So before we have a break, let's just talk about Americans. So with Europeans, you can only exercise at the end. That's why we could do it nicely like that. If it's an American, though, you get the choice of exercising early, which means you could exercise it here, or you could exercise it here. Obviously, you wouldn't exercise it here, right, because you get a negative payoff, but here you get a $1 payoff if you exercise early. So your decision rule is to compare the payoff from early exercise, so in other words, 22 minus 21, with bringing back the value of this payoff to that time period here. So in other words, rather than discounting back the $3.20 6 months, discount it back 3 months. So it's going to be the present value, e to the power of negative 12% times 3 on 12, you're bringing it back 3 months, multiplied by 3.2 times P, okay, because you're bringing it back just one lot of P. You compare those two numbers, and you choose whichever number is higher. So if the value of the 3.2 bringing it back is higher than $1, then you have to write down, do not exercise early, because keeping the option value higher, or keeping the option has a higher value. If, however, you brought back that $3.20 and you got an amount that was less than $1, then you would say exercise the option early because it leads to a greater payoff. And then you discount back whatever's higher, either the dollar or that $3.20 discounted back to times 0 to work out the value of the option. Okay, which is what we're going to do after the break. Okay, so we'll start a couple of minutes after 12. If you have any questions, please come down and see me. Okay, so we're going to have a look at this now, and we're going to value it as an American option. Okay, so we're going to go ahead and value this as an American option. Okay, so just make sure it's recording. Yep. So what if it was an American option? So we've got the same setup. We start at 20. We can go up to 22, down to 18, up to 24.2. In the middle we have 19.8, and down here we have 16.2. Here again, the payoffs were $0. Okay, so there was zero payoff. And up here we had a payoff of 3.2. Now when you have American options, I always like to do what I call label the nodes. Okay, so we give them values. So what we're going to do is, we're going to bring this $3.20 back to node B and then compare it with early exercise. So we say the value of the option at node B is equal to, so the present value, e to the power of negative 12% times a quarter. We're bringing it back 3 months, just one time step. Multiplied by the payoff of $3.20, and to get from node B to node D, you went up the tree, so you multiply it by P, which is 0.6523. That gives me 2.0257. 2.0257. And then you need to make this statement. Okay, early exercise. So that would be saying 22 minus 21. Early exercise would lead to a payoff of $1. Okay, that's 22 minus 21. So do you think you exercise early? Would you rather $1 or $2.0257? Do you exercise early? No. Right, you want the greater amount. So therefore, I would not exercise early. And keep the value of 2.0257. Okay, and in an exam there's a mark for saying that. Right, you need to say whether you exercise or do not exercise. Then this 2.0257, I need to bring that back to node A. So I say e to the power of negative 12%, and I'm bringing it back 3 months, a quarter of a year still. And now I say 2.0257. To get from A to B, I went up the tree, so I need to multiply it by P, the probability of moving up the tree. And that gives me 1.2823. In other words, the same as the European. Because you chose not to exercise early, the American and call option are worth the same in this particular question. Okay, that's because there was no early exercise of the option. We're going to have a look at early exercise when we look at the put options in a few minutes. But the basic thing you have to do here is, if it's American, you need to bring everything back. You need to bring this back to here, find its value, compare it with early exercise, and then the greater value you bring back to node A. You'll notice I didn't do anything down here. That's because the values were 0. Because they're 0, there's no point discounting them back, because 0 times anything is just going to be 0. That's why I ignored them. Okay, but in the end, I end up with the same price for the American option as for the European call option. So let's write out my rule. So my rule is, and this is all about early exercise, the rule is compare your calculated option value to the value of early exercise. So in other words, I compare this 2.0257 with the early exercise of $1. So I compare 2.0257 with S minus X. So 2.0257 with 22 minus 21. So 2.0257 with $1. As the option value is greater, there is no early exercise. Okay, so you don't exercise early with this American option. Any questions? Okay, so that's what we've done. So now what we're going to do is we will go ahead and have a look at a put option. The great thing about whether it's a call option or a put option is it's exactly the same formula. You're still going to take into account the time value of money, still going to take into account the probabilities, and still going to take into account the payoffs. Obviously, what changes is the payoffs will be different. The payoffs become X minus ST rather than ST minus X. Okay, so before we had a question where we went to certain dollar values. This time we have a question where I tell you prices can move up or down by a certain percentage. Okay, in this case, 20%. They can move up or down by 20%. So first of all, let's have a look at the European one, where we don't have early exercise. So U, because it's a percentage increase, is just 1 plus the percentage increase. So 1 plus 0.2, U is going to be equal to 1.2. D is 1 minus the percentage decrease. So 1 minus 0.2 gives me 0.8. So those are my values for U and D. And then for P, same formula. ERT minus D divided by U minus D. Exactly the same formula. In this question, though, there are 2 time steps of 1 year each. Okay, so each time step is worth a year. So this is a 2-year option that you are valuing. Okay, but again, when you calculate P, you do the length of 1 time step. And then that P will be the same for the second time step. Okay, exactly the same. So in terms of my formula, the risk-free rate was 5%, and I multiply it by the length of a time step, which is 1 year. Minus 0.8 divided by U minus D, 1.2 minus 0.8. That gives me 0.6282. When you're solving for P, I'm happy if you round to 4 decimal points. Okay, you do not have to keep all the decimal points on your calculator. Okay, that just becomes a little bit cumbersome and you'll probably make mistakes. Okay, so I'm happy for you to keep 4 decimal places when calculating P. If P equals that, 1 minus P equals 1 minus 0.6282, which equals 0.3718. So what other information were you given in the questions? You were told that the initial stock price, S0, was equal to $50. So you actually have to draw the tree in this question. Okay, it's not drawn for you. It's a 2 time step tree. We start at $50, and then we just multiply by U or D to go up or down the tree to find the spot prices. So here it's going to be $50 times 1.2. That's my U moving up the tree, which gives me $60 here. And then this is going to be 60 times 1.2, which gives me $72. Then your D is 0.8. So 50 times 0.8 gives me $40 here, and then 40 times 0.8 gives me $32 here. And then here I can either say 60 times 0.8, or I can say 40 times 1.2. Either way, you get the same amount of $48. Okay, $48. Everyone happy with this setup up here? Anyone like me to explain it more? How we calculated P? Everyone happy with 1 minus P? Everyone happy with how I drew the tree? The tree wasn't given to me. I was told your initial stop price is $50. Prices can go up or down by 20%. So all I did was multiply by 1.2 or 0.8, adding on 20%, subtracting 20% to get my values on the nodes. Okay, that's all I did. This option has a strike price of $52. It's a put option. So I have the right but not the obligation to sell for $52. So let's do it. Do I exercise the option here? No. So my payoff is, why? Because I'd rather sell for $72 than $52. What about here? Do I exercise the option? Yes. And what is my payoff? $4. Right? 52 minus 48 to give me $4. How many lots of $4 are there? 2 lots. Okay, there are 2 lots of $4 there, because I can either go up then down to get 1 lot of $4, or I could go down then up to get the other $4. So don't assume there's just one $4 there. There's actually 2 lots of them. Do I exercise here? Yes. And what is my payoff? 20. 52 minus $32. Very good. Any questions on those payoffs? And then all you do is put it back into that formula we had before. Because this is a European, you can do it all at once. You don't have to worry about the middle steps, because you can't exercise it early, because it is European. You have to wait till the very end. So we're going to bring back the $20 and bring back the 2 lots of $4 to find the value of this put option. And it's exactly the same formula. The value of the put option is going to be equal to the present value, e to the power of negative RT, times the probability of moving up the tree, multiplied by the payoff if I move up the tree, plus my probability if I move down the tree, 1 minus P, multiplied by the payoff if I go down the tree. Okay, so exactly the same formula. So, this bit here, e to the power of negative 5% times 1 year, but there's 2 lots of those. It's a 2-year option. Remember, because this is European, I can do it all at once. This $20, how do I get this $20 payoff? How many ways are there to get it? 1 way. And what are those 2 ways? To go up or down? Down the tree twice. Probability of going down the tree once is 1 minus P. The probability of going down the tree twice is 1 minus P multiplied by 1 minus P. Okay, so 1 minus P squared. So that $20 payoff gets multiplied by 1 minus P, which is 0.3718, and I square it. Okay, because I've gone 1 minus P times 1 minus P. What else? Well, I've got this $4 payoff here. So I say $4, but I'm going to multiply it by 2 because there was 2 ways to get that $4. Either I went up then down, or I went down then up. Now what do I multiply that by? What do I multiply it by? P times 1 minus P. Whether you go up or down then up, you're multiplying P times 1 minus P. Either it's P times 1 minus P, or it's 1 minus P times P. Either way, you're multiplying the same 2 numbers together. Okay, so I multiply that by 0.3718 times 0.6282. If you really wanted to, you could say $4 times 0.3718 times 0.6282, and then $4 times 0.6282 times 3.718, but you'd get exactly the same number. Okay, so it's easy just to multiply by 2, rather than doing the same 2 calculations, just in a different order. That gives me 4.1923. Okay, that is the value of this European put option. Any questions on that one? So what if it's American? Okay, if it's American, we have that decision about early exercise. Okay, so what if it's an American option? Okay, again, same setup. Okay, this doesn't change. Payoffs over here don't change. Okay, that doesn't change. What we're going to do, though, is we're going to label the nodes. This $0, we're not going to worry about it, right? The present value of 0 times any probability is 0. This $4, I need to bring that back. Sorry, so this 0 we ignore. This $20, I need to bring it back to node C. There's only one way to get from C to F, right? And that is to go down the tree. This 2 lot of $4, however, okay, they're going to go, one lot's going to go to here, and the other lot is going to go to here. Okay, because you could go from B to E to get $4, and from C to E to get $4. So you need to have a look at what happens at these nodes. So one $4 lot goes there, the other $4 goes down there. Any questions? So first of all, let's see what happens at node B. So at node B, we're bringing back one lot of $4 1 year. That's the length of the time step. And it's $4 times, to get from B to E, you went up or down the tree? Down, so I have to multiply it by 1 minus P. So I have to multiply it by 0.3718. Okay, to get from B to E, you went down the tree. So the probability of getting from B to E is 0.3718. So that's the probability of getting that $4. That gives me 1.4147. And I compare 1.4147 with 52 minus 60, which is -8. Do I exercise early? You should be yelling this out. Do I exercise early? Well, if I exercise early, I get -$8. Do I exercise early? Thank you. No. Okay, and I keep the 1.417. But you need to state that. So do not exercise early at node B, and keep the value of 1.4147. Now I need to find the value at node C. So I need to bring that $20 back to C and that $4 back to C. And then I compare that with early exercise. So at node C, it's going to be equal to the present value. So e to the power of -5% times 1. I'm bringing it back one time step. Each time step's worth 1 year. I'm going to bring back $20, and I'm going to bring back $4. To get that $20, to get from C to F, did I go down the tree or up the tree? Down or up? Not tricky. Did I go down the tree or up the tree? Down. So what do I multiply it by? 1 minus P. Fantastic. So I multiply it by 0.3718 because I went down the tree. So that's my probability of getting the $20 is going down the tree to get the $20. So I've got to multiply it by 1 minus P. And then the $4, well, to get that $4, I went from C to E. So I went up. Fantastic. I went up the tree. So I've got to multiply it by the probability of going up the tree, which is P, which is 0.6282. So I plug that in my calculator and I get 9.4636. And then again, I compare that with early exercise. Okay, so compare with early exercise. So at node C, early exercise would be 52 minus 40, which would be $12. Do I exercise early at this node? Yes. Early exercise gives me a greater amount of $12 than 9.4636. So as early exercise leads to a greater value, I exercise early. So if you look at this diagram here, right, so the value is 9.4636. The value here is 1.4147. But because I have early exercise of $12, I bring $12 back to here, and I bring 1.4147 back to here. So I don't bring back the lower amount, I bring back the higher amount of $12, and I bring back that value of 1.4147 because I didn't exercise early there. So that gives me a value at node A equal to present value, so negative 5% times length of one time step of a year. I have that 1.4147. To get from A to B, to get that 1.4147, I went up the tree, so I need to multiply it by P, which is 0.6282. And then this $12, to get that $12, you went down the tree from A to C. So the probability of getting that $12 is 1 minus P. So $20 multiplied by $12. $12 times 0.3718. And that gives me 5.0894. Am I done? No. You're not done. Because you can exercise early at node A if you wanted to. So you need to make a statement about whether you would exercise early or not at node A. So the value of exercising at node A is 52 minus 50, which equals $2. Do you exercise early? No. Right? So you do not, as 5.0894 is greater than $2. Do not exercise early at node A. And the value of the option is 5.0894, as you originally calculated. So it's really important you do have that check of whether you would exercise it at the very beginning at node A. One year I didn't, it was a bit nasty of me, I did an exam with a 3-step binomial tree and worked out you exercised it early at the very beginning. Right, but of course you got marks for all the other work as well. Yes? That's right. So you don't exercise it early. Yeah. No. So, yep, that's fine. Good question. So, question is, why have I brought back 1.4147 rather than 0? Because that's the value of the option. So the choice is, do I use the value of the option, which is 1.4147, or do I use the value if I exercise early? Now, the value if I exercised early would have been -8, so I don't exercise it early, so the value is 1.4147. Okay, so that $4 I brought back is worth 1.4147. I compare it with early exercise. If early exercise is larger than 1.417, I would have replaced that with the larger number, but it's not. Early exercise gave you a negative amount, so instead I just bring back the 1.4147. So at all these nodes, what you're looking at is, do I bring back the value I've calculated, or do I bring back the value of early exercise? And the answer is you bring back the higher number. Early exercise there was -8, so I bring back the 1.4147. Down here, the value was 9.46, but early exercise was $12, so I bring back the $12. And some people also think, well, because you've exercised there, don't you ignore what happens up here? The answer is no, because remember, that's one state of the world going down. I could have gone up, which means I didn't have the choice of early exercise. Okay, so you need to bring back all the relevant values. These are just different states of the world, and you don't know which one you'll end up in. So all the values, you've got to bring them back, excuse me, to the very beginning. Are there any questions on this? Yeah, exactly the same. So early exercise, all exactly the same. Same formula. The only thing that differs is the payoffs, right? Because rather than ST minus X, it's X minus ST. But the same, you do exactly the same method. You calculate P in the same way. You calculate U and D in exactly the same way. The only thing that differs are the payoffs. The present value probability formula, also all exactly the same. The only thing that differs will be the payoffs you calculate. Okay, but everything else is exactly the same, no matter whether you use call or valuing call or put options themselves. Other questions? Okay, so remember I said there are 3 ways of calculating excuse me, U and D. So I can give you dollar amount changes, so going up or down, $22, $18. I can give you a percentage increase, 20% increase, 20% decrease, or I could tell you the overall volatility of the stock, okay, which we measure by standard deviation. Okay, so if I tell you the stock has a volatility of 30%, then to calculate U, it's just e to the power of that volatility of 30% times the square root of the length of one time step. Okay, the length of one time step. And then D is just 1 divided by that number you've calculated. So 1 divided by U. The reason we can use this, or we like to use this method, it's kind of like the preferred method, is because volatility can differ weeks to months. But over the course of a year, we kind of get like a fairly stable sort of idea about what volatility is like. So if you look at the stock market, so you look at, say, the ASX 200, the top 200 companies in Australia, you'll get a volatility of about 17%, 16, 17%. For an individual stock, it's normally something like 25 to 35%. Obviously, when you combine lots of stocks, you get rid of firm-specific risk, so you're left with the market risk. That's why it's got a lower volatility, right? Because you've diversified away certain types of risk. Okay, so this is kind of like the preferred way, excuse me, that you'll see out in industry. Okay, practitioners in terms of valuing this. Okay, so we've got some questions during the break. And this is where I want to be really careful. So one of the questions is, can I use this now to go and value options? And then in my head, I'm thinking the next question is, so I can trade on them and make some money. Okay, so be really careful, right? Really, really careful doing this sort of stuff. Okay, I do not hold that any of what I'm teaching you in here is financial advice. Okay, it is not financial advice, right, for you. This is just showing you the different ways that these things are valued in the marketplace. Okay, so today, this week, we've used one method, right, the binomial option pricing model. It's the method that's normally used to value American options. Okay, so this is normally the method we use to value American options. Next week, we look at something called the Black-Scholes option pricing model. It's a far more complicated model, and it's the one formula you get in your final exam, right? So I give you the formula for Black-Scholes in your final exam. And that's used for valuing European options. It takes into account not the P sort of stuff, but it takes into account, thank you, takes into account volatility, spot prices, strike prices, risk-free rates, and then looks at the probability of exercise based on distribution tables, okay, which you'll of course get provided to you in an exam as well. I wouldn't expect you to memorize those. Right, but these are one method, right, that can be used in the marketplace, okay, to value options. Just like when you did Foundations of Finance, we gave you one method, right? One method, or a couple of methods, because we introduced WACC, weighted average cost of capital. Methods in terms of calculating values of projects, values of shares. Not perfect, right? So please don't rely on these to go and trade on the marketplace. This is giving you a skill set, right? So you can compare, try different methods, come up with sensible recommendations, okay, in the companies you might end up working in one day. My final advice would be is please don't trade in options. Right, don't trade in any sort of derivative contract using your own money. Right, it's a surefire way to sure you may make some money, but over the long term, I guarantee you'll probably lose money. Okay, so be really careful in terms of thinking, I've just done, you know, a couple of hours on forwards and futures. I've looked at one method, I'm going to go and trade on this sort of stuff and make lots of money. You won't. Okay, unfortunately, there are smarter people out there using computers to do it all for them. So not smarter people, but smarter programs, right? Because computers are trading on all this sort of stuff using algorithms, right? So go and learn some algorithms, join up to a company, see how they do it, and then maybe go and trade on it, right? But I certainly wouldn't be trading on this based on what you've been taught so far. Okay, what you're doing at the moment is expanding your skill set, expanding your knowledge, okay, about how you can go and trade on these things, how you can value things. And ultimately, it's all about providing recommendations. Okay, so thinking about what happens in the real world, compare it with what you've learnt in here, and then providing recommendations, okay, to your boss or whoever you end up working with. Okay. So, you know, I don't trade in shares anymore. I've lost too much money. Right? I research on this stuff and I still lose money. Okay, so just be careful. I went to China. We have some partnership agreements in China, and so I was visiting some students. It would have been about four or 5 years ago, right? And we were talking about the stock market, and I was saying, be careful, be careful. At that stage, the stock market was going up and up and up. And they said, no, you can't lose money in China. And I said, I don't know about that. Right? I said, that doesn't sound right to me, right? And then the next time I visited, they'd lost, 70% of the money they'd invested, right? Because, what goes up does come down, right? So just be careful. And no one can explain to me, right, how the Chinese stock market works. Everyone I ask says it's like a gamble, right? So just be careful with whatever you do. So look, we've got a bit of time left. So what I will do is I will stay down the front and answer questions you might have in regards to your mid-semester exam next week. So think of this as like a little bit of extra consultation time. In terms of the lead up to your mid-semester exam, just use the normal consultation times that are up on Waddle, right, to go and chat with the tutors and myself. Again, your and my opinion might differ, right, but I don't think your mid-semester exam is a difficult exam. You may disagree afterwards, right, but in my head, I think it's a very fair exam. Okay, but I will remain down the front if you do have questions. Thank you.